So you just heard Tom give you the lowdown on protection, how to protect your family, your income, your lifestyle. Then he went through cash flow, where he spoke about how to become a world-class saver. In this meeting, I'm going to go through investments on how we see them and how we think about them. So that if you're looking for investment 101 type of information, I'm going to provide a little bit of that, but for the most part, you can take a lot of the concepts that I'm going to talk about in this video and Google them. If you haven't heard of a certain thing, if I start speaking jargon or if I start saying words you've never heard before, you can easily go to Google and search those and find the answers that will give you beyond, so then you know what I'm actually talking about. Now, when it comes to investments, most people I talk to understand what it means to be diversified on the investment side, right? You don't have all your eggs in one basket, and you put your investments, whether it be in a 401k or a brokerage account, you put it in multiple different places, stocks, bonds, some small companies, some large companies, and that's generally an accepted principle when it comes to investments. Just don't have all of your eggs in one basket. You spread around the risk among multiple companies. But I'm going to talk about diversification also in two other ways, because we don't think that diversification just on the investment side is giving the whole picture. So when we think about diversification just from the investments, we also think about diversification in the form of tax diversification. So there are multiple different places that you can put money, and to understand which places you put money that are going to be tax deferred, taxable, tax advantaged. Whenever you understand that not all assets are taxed the same, then that will also allow you to understand where the best place to put your money is, especially when it comes to today relative to your retirement. And then the third way that we see diversification, that we look at it, is through liquidity. So if you've never heard of liquidity, liquidity is the speed in which something turns into cash. Some assets turn into cash really fast. Some assets take a very long time to turn into cash because you can't just sell those assets. Like a home, you don't just sell a home in a day or two, right? It takes a while. You have to put it up on the market. You have to have somebody come by and see it. Then they have to put in an offer. And so there's a lot longer of a time period in order to sell a house than, let's say, there is to sell a stock that you have in a mutual fund. Those kinds of things. When it comes to tax diversification, there are three different places that you can put money, three different tax profiles, if you will, for investments. You have tax deferred, taxable, and tax advantaged. So a tax deferred vehicle is something where you put money away and the IRS allows you to deduct that contribution to that asset from your taxable income this year. Now, it's deferred. You're deferring the tax to a later time. So whenever you take the money out, it's going to get taxed, right? You weren't taxed on the money going in, but you'll get taxed on the money coming out. A taxable investment may be something like residential real estate. If you buy a property, right, and you use it as an investment, then you can buy that property, let's say it's $150,000, and then it grows to $200,000, and then you sell it. Well, that means you have a gain of $50,000 as an example, hypothetical example. So a taxable asset is something that when you sell it, or if it earns income to you, it's taxed whenever you get those proceeds. And then the third type is tax advantage. So tax advantage is usually things like a Roth 401k. There are certain advantages to putting money into a Roth 401k over a traditional 401k. However, there are also some downsides. And depending on who you are, you may want to defer the tax. You may not want to defer the tax. If you know with absolute certainty that you're going to be in a lower income tax bracket when you retire, right? Maybe a tax deferred vehicle is actually better than a tax advantage. So I have to defer to your accountant, and I have to kind of defer a lot of the tax stuff, right? We want tax advice. It's got to come from an accountant. But it's important to understand how multiple different places that you can put investments can have different tax consequences. And sometimes you can take the same investment and put it in a tax deferred or a taxable or tax advantage. Like you can own the same stuff no matter what the shell of it is. So just because you have a 401k a Roth 401k or a traditional 401k, neither one of them is more risky than the other because it's just the shell of the account that you have, and then you buy investments inside of that account, right? So it's the account shell, not necessarily the investments that it's in. And then clearly, right here on the screen, you can see we split it up into 3 different categories as far as short-term, mid-term, and long-term, because if you're going to need money sooner rather than later, it's probably not a good thing to do to block it up in something that is a long-term asset. So if you're 25 years old and you put money in a 401k, it's not accessible without paying taxes and a penalty. So it's important to be balanced in how you approach where you're putting your savings. You don't want to have it all in long-term or all in short-term, right? Try to start putting a little bit in a bunch of different buckets and build up those buckets over time, rather than shoving all of your money in one of these 9 squares that are on the screen. When it comes to risk, there is a spectrum of risk. And when you think of risk in regards to how investments work, people got least risk over here, most risk over here. When it comes to risk and investments, if you're taking risk, the idea is that you get a return for the risk that you take. So what's the least risky asset? Probably cash, right? It's not going to return anything, but it's not going to go anywhere either. It's not going to lose money over time. Not like a 401k where you might have money invested and then the market goes down and then the 401k goes down because it's invested in the market, right? There's risk of loss in stocks that cash doesn't have, right? So cash is very, very, very riskless. So then you have probably, money market funds here, right? And then you have like bonds here. And you have just a little further out stocks. And then you've got different types of bonds. You've got municipal bonds, you've got corporate bonds, you've got T-bills. You have different types of stocks. Large companies, small companies, mid-cap companies, value, growth. And as I go further to the right, for all of you business owners out there, right, we typically will say that your business is all the way over here because it's a concentrated ownership in one business. Stocks are ownership in a bunch of different businesses. So when you have a stock mutual fund, you might be in 30, maybe 300, maybe 3,000 stocks in that mutual fund. That's more diversified. So it's considered less risk than if you own one business. And for veterinary business owners out there, you may have the majority of your wealth in your business, and that's okay. But it's important to recognize that on the risk spectrum, right, you're probably, if most of your wealth is in your business, it's important to recognize that as you build up assets outside the business, to know from a risk perspective where you want to be. Oftentimes, business owners carry a lot of cash. Right? They instinctively know that there's this inherent risk in their business, and so they keep a lot of cash on hand because they know at any point in time they may need that cash. And then, if you wanted to put like commercial property here, right, commercial real estate, a little bit further, maybe residential over here, and you get the picture, right? So plot your own assets. How much do you have in a bunch of these different things? How much risk are you taking? Are you getting rewarded for that risk? They're all important questions that you want to ask yourself. If you have a lot of cash and you're not really sure what to do with it, and we call it dead cash, cash that is in your account, checking account, savings account, any account, that is not working for you, but also not providing you security. So what I mean by that is, there's a certain level of money that you need to have that's in your checking account or your savings account that's accessible, that's in your business account. There's a certain level of cash that you need to have in order for you to sleep at night, right? In order for you to feel comfortable laying your head down and not worrying about a bill coming in that you can't pay. Because clearly, cash is the only separation between us and more short-term debt. The only reason why you have short-term debt is because you didn't have the cash. So dead cash is all that money that is neither helping you sleep at night, nor is it working for you, right? And so you got to figure out, okay, what am I going to do with this cash? How am I going to put it to work for me? And to put that numerically, if you have $100,000 in your checking account, but you would sleep just as well if you had $30,000 in your checking account, then that means that there's $70,000 in there of dead cash because it's not helping you sleep at night and it's not working for you. If you have a lot of cash on hand, you're not really sure what to do with it, easily just fill out the form below this video. We're more than happy to help you, guide you on where you might be able to put that money. So where do returns come from in investments? So I talked about diversification, talked about risk. Now I'm going to talk about returns. Where do returns come from exactly? Returns come from two places. The first place is it's capitalism, right? It's a system, it's a capitalistic system. The second place it comes from is stocks and bonds. Now, if you're unfamiliar with what a stock is or what a bond is, Google it. There's a bunch of YouTube videos out there that can explain it really in detail, depending on how curious you are. But stocks are ownership in companies. Bonds are kind of like loans. You know, they're promissory notes that will be paid in the future. If you were to think of what is the one thing that drives investment markets on a daily basis, there's so many things out there that can affect the stock market, that can affect the bond market, right? Interest rates, the economy, taxes. But really, one thing probably impacts it very dramatically, very quickly, and that's information, right? Information. If some information is released, the market responds pretty much immediately. Think of the coronavirus. Think of the 2008 housing crash, right? The market responded very quickly to negative things. So when it comes to investing, recognizing that there is a difference between price and value will help you know the exact reason why people invest. If you were an investor, you would be looking for investments, assets, if you will, that have a lower price than what they're valued at. It's kind of like when you go buy a car. You go on the car lot, you see the price for the SUV, it says $45,000. Do you just walk up to the sales guy and say, hey, this sticker price is $45,000? Let's do it. Draw up the paperwork. I'm going to write you a check for $45,000. No, you wouldn't do that. That'd be ridiculous. You go to Kelley Blue Book to find its value. And then you come back to the dealership and you negotiate to try to get that price as close to the value as you can. So when price is not value, when price is below value, that's how investing really works. You're looking for those things where the price is below the value, and even if you're half wrong on the value, you're still going to make money over time because you're expecting that the investment, that the market is going to recognize that the value of that asset that you just bought is actually higher than what you bought it for, and it will come up to its value. 3 philosophies of investing. Conventional is probably the most common one. It believes that you can get the information before anyone else, and you can translate that information to how it's going to impact your investments faster and better than anybody else out there. Indexing is this idea where you set it and forget it. You buy an index, the S&P 500, the Dow Jones, whatever index that's out there. You buy an index and you hold it, and whatever it's going to get is whatever you're going to get. And that's why there's a sailboat there, right? You kind of set your winds, your sails to the wind, and you let it ride. And you just kind of, I don't know, not a whole lot of maintenance. It's very passive, and you have multiple different indices that are out there that you can invest in. And then the third kind is what they call structured investing. So structured investing is really looking at your portfolio and thinking, okay, I'm gonna diversify, but then I'm gonna tilt my portfolio towards the asset classes, the asset types, if you will, that outperform the others over time. And so it's a little bit more, it's definitely more passive than, say, conventional money management, but it's not entirely just it's not just buying an index, right? You have mutual funds that you specifically buy, and then you're buying more of some and less of others because you believe that those assets are going to outperform over time. 4 rules to investing. So these are the boundaries you got to follow. If there's anything, if there's a rule, if there's a system that you're going to follow when it comes to investing, this is probably the best one that I can think of to follow. The first rule is to invest in stocks and use bonds to manage risk. So bonds are your airbags. When the market is tanking, when things are not looking so good in the market, typically you can manage that risk, that loss, with having some bonds in your portfolio so that whenever whenever the stocks come down, at least your bonds aren't going down with them. Rule number 2 is to be diversified. Diversify amongst a bunch of different investment classes. Rule number 3, rebalance, and rebalance often. Rebalancing is this idea where if you have, you have multiple investments, each investment will grow at different rates. And then over time, as they change the percentage of your portfolio, you will rebalance them, you reset them, you get them back to where they were originally. If you have 50% stocks and 50% bonds, and the stocks grow faster than bonds, then eventually that portfolio will become 60% bonds and 60% stocks and 40% bonds. And so what you do is you sell that 10% of stocks that is increased by as a percentage of the portfolio. You buy more bonds and you get it back to the 50-50 mark. 4th rule, to behave. This is the hardest rule to do. You invest in stocks and bonds, or you invest in real estate or whatever you invest in. And as the market goes up and down, hopefully you can emotionally handle the wave and the roller coaster that you're on. Now, typically, if you get number 1 right, like if you pick the portfolio that is going to work for you in all situations, whether the market's up or whether the market's down, most likely it's going to be easier for you to behave and not panic when the market comes down so much that you just can't handle it anymore and you sell your investments, because that's what people do. The market tanks, 20-30%, did so during the coronavirus, and people got really scared that it wasn't ever going to stop going down, and they sold their investments. When you time the market, when you're trying to time when to get in, when to get out, you can't just be right on when you get out. You have to be right on when you get back in, right? So when the market drops, like, okay, you got out, but like, now when do you get back in? And by the time you get back in, market might be back up. A couple of examples in history that we have where the market had a sharp decline and a sharp increase. So it's just hard to predict those things. And so it's better to just behave when the market's going crazy. Just set it, let it go, and don't make any rash decisions based on what you hear in the media. Okay, so now let's talk about investments, investment fees, talk about taxes. We're going to look at a couple different portfolios, and I think the first illustration that I'm going to go through here is to give you an idea of when you put money in an investment. So I'm going to go through a 50% stock and 50% bond portfolio, right? So it's balanced. And just look at what it's done, 1984 to 2018. And you can see the squiggly line, right? It's a roller coaster somewhat. Goes up, goes down, goes right, goes left. And I think there's a couple different really cool things to look in here, to investigate, to understand how the behavior of investments work. So you'll notice, so this is someone putting $10,000 away into a portfolio every year. And you'll notice the first few years kind of steady eddy goes up. And then something happens in 2000, 2001, and 2002. And if you look at the numbers, it goes down, but it doesn't go down a whole lot. It goes from like 506,000 down to 504. What's incredibly interesting about this time period is that the market went down 3 years in a row. Went down a lot over the course of that 3 years. But yet this portfolio is not really going down that much. Why is that? So the reason why is because if this person is saving $10,000 a year and the market goes down and your portfolio goes down 10,000 and you're putting money in at 10,000, it's going to impact the portfolio a whole lot less. Right? The consistency of savings and making sure that you're putting money in every year can sometimes have a positive impact to your portfolio. That's why this line looks so good as far as it's increasing, right? It comes down a couple times, but for the most part, it looks very smooth. It looks like it's going up. Now, does it mean that it didn't go down ever? No, it went down multiple times. In fact, during those years where the market was going down, it would go down, it would go up, and it would come back down. It was all over the place, very volatile. So I think it's important to recognize that putting money in, saving money, the consistency of savings is more important than necessarily the investment rates of return that you get. Now, the other thing about this illustration is that at the end of this 35-year time period, this person would have $1.6 million in their portfolio. Except, what about fees? What about investment fees? So investment fees are very important to recognize. When I click on this button, it's going to show the impact of investing fees Now here I have a hypothetical 2% investment fee, right? Depending on what you're invested in, might be higher, might be lower. And we're talking about advisory fees, mutual fund fees, 12B1 fees, all of the fees that are in your investments. You might find a fee and go, oh, there's my fee. No, there's multiple fees. There's trading costs. So it's important to recognize that fees can have this dramatic impact on a portfolio, because instead of 1.6 million, this portfolio turned into 1 million, right? This is $600,000. That's advice that cost you $600,000 over the course of a 35-year time horizon. It can make a big difference. You really want to understand your fees and how they work when it comes to investments. And then if I look at taxes, how would taxes impact this portfolio? Well, that $1 million, even after taxes, turns into $833,000. So when people are looking at investment rates of return, when they're looking at these projections that show, you put $10,000 away every year and you get $1.6 million, recognize that there are fees, there are taxes, and whether, some people say, well, I don't have taxes because it's in a Roth 401k or a Roth IRA. Well, great, that's fine. You didn't avoid the investment fees. Most likely, if you have a Roth IRA and you're investing in mutual funds, there are mutual fund fees. So just be aware, recognize that those fees can impact your ability to build wealth, and make sure you take responsible caution when it comes to what you invest in. And another thing that will oftentimes people ask, well, why don't I'm young, I have time, why can't I just put it all in stocks? CJ, what's wrong with putting everything that, especially because, I'm putting it in a 401k, I've got, 35 years before I can get to it. What's wrong with just going for the gold, putting it all in stocks? And my answer is always in an illustration from a few years ago, because we really don't know what the future is going to look like. We can look at the past, and the past can teach us lessons about the future, but we live in a world entirely different than we did 20 years ago, right? The iPhone came out in 2007. It was just 13 years ago, right? 14 years ago that it was released. So 20 years ago, the world was dramatically different in the year 2000, 2001. So when you look at long 35-year time horizons, you get these massive numbers. $10,000 a year turns into $1.6 million. Well, remember that we don't live in 35-year increments. We live in days. And as you get closer to retirement, you're going to want to take less and less risk, because you're not going to be able to withstand the type of volatility, most likely, that you could whenever you were younger. Because when you're younger, you're like, hey, it's locked away for 30 years. What, it's down today, it's fine. I got time. I have time. People say that a lot. But if you look at investments, and especially if you're diversifying from a tax perspective and diversifying from a liquidity perspective, it's good to recognize that investing, having all your money in one type of investment probably isn't the best thing. This is an illustration of over 10 years, just over the 10 years from 2000 to 2010, to see what would have happened to a portfolio if they put $10,000 away. And the result of this, they put $10,000 away for 10 years. They would have $123,000 before taxes, before fees, if you just did 100% stocks. Okay, 100% stock portfolio. I count the fees, I count the taxes, and now we're down to $101,000. Okay, so $101,000 if you had your stocks in a liquid investment account. Remember, $10,000 over 10 years, that's $100,000. So they had made $1,000 over a 10-year period in this account. If we were to say, well, this is 100% stock, what would a portfolio that was 100% bonds look like? Let's look at that. 100% bonds over the course of that 10 years. Because remember, you got to get to year 10 before you get to year 35. And what this illustration shows, before taxes, before fees, you have $133,000. After taxes, after fees, you'd have about $116,000. So you'd have about $15,000 more in this portfolio than you would stocks. Does that mean you need to be in all bonds and not stocks? No. But it's an illustration to show how you might just want to be more diversified and not have all your money in bonds or all your money in stocks, because depending on the time period that you look in will depend on the result that you're getting. And if you need that money in year 10, who knows what's going to happen in year 10? Who knows what's going to happen in year 8? I don't even know what I'm going to eat for lunch next Tuesday. It's important at least be diversified from an investment perspective. So if you need to call on those assets, you're not adding insult to injury and selling those investments at a time when they're down, because the timing of your life doesn't always correspond with the timing of the market. One last thing to consider is investment or assets that may not be market-based at all. They might not be tied to the stock market or the bond market, right? Some assets that are out there are guaranteed. Consider that maybe a portion of your assets should be in things that are guaranteed, so that whenever life does decide to change its mind and you're not prepared for it, you at least have assets that are liquid that you can have access to where you're not going to get in any trouble. And lastly, if you need help with any of this stuff, fill out the form below. We're more than happy to reach out to you, schedule a time to have a phone call or a meeting. Reach out to us. We'll have somebody from our team reach out to you, check off the boxes in the form of whatever you're looking to get. If you want to give us a description of what you're looking for, just let us know. Reach out to us. We're here. We really want to help you. We really want to make sure, whether it's us or somebody else, we just want to make sure you get the help that you need. And in this next meeting, so the next meeting is going to be on strategy. I'm going to talk about how to strategize on getting income in retirement. Investments are just one piece of the puzzle. They shouldn't be the puzzle. And so I'm going to go through that in this next video. I'm going to go through how to manage the risks in life that you will adopt when you get to retirement that you never even thought you'd ever deal with. These risks are not things that we typically talk about when you're in your 20s or your 30s, but it's important to know and start with the end in mind of what you're working towards. Because there's a lot of things that you'll deal with in retirement that you didn't think not only did you not think you'd ever deal with them, but the risks right now are completely different and they flip on their head whenever you get to retirement. And then I'll go through ideas on what you can do today to start preparing, not just for retirement, but also for tomorrow. Remember, we've got to get through tomorrow before we get to next week. We got to get through next week before we get to 10 years. We got to get through 10 years before we get to 30 years from now, whenever you retire, right? So, and if you're in right now in that 5 to 10 year time horizon before you actually do retire and sell your business, now is an absolute critical time to be getting all this stuff together and make sure that you not only understand what you have, but understand how you're going to get income when you get to retirement. It's not just about getting to retirement. We've got to get through retirement. Retirement day is just halftime. It's not the end of the game. And the Atlanta Falcons thought they were going to win that Super Bowl. You remember that? 28-3. Patriots flipped them on their heads in the next half and took it home, right? They won. So we got to make sure we get you not just to retirement, but through retirement. I'll see you in the next video.